Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Alex Matthew. Sometimes you have the opportunity to utilize what is called leverage to make a strategic decision to invest when you think that the prices are appropriate. What am I talking about? There is a concept called loan against securities, which some people, usually people who are relatively well off, they're loosely called HNIs and ultra HNIs, utilize this service to take a loan against something that they've invested in when they think that the markets are attractive. There are other uses also of loan against security, and we'll talk about whether you should use it, what are the pros and cons, what should you be aware of, and when in your life cycle should you consider doing it. I'm joined today by Harshvardhan Rungta, who is CFP and the co-founder of Rungta Securities. Harsh, thanks so much for taking the time.
My pleasure, Alex.
So let's talk about this. This is a concept that I have heard people speak about, but interestingly, more often than not, I've heard retail investors talk about loan against security and making investments in the stock market. What is the primary purpose of this service and how does it work?
So, well, if you look at the concept of loan against securities, that is to be able to borrow against an investment that you've made. Now, what would you borrow for is another topic. So just let's look at, suppose you've hypothetically invested into a set of mutual funds. You have, say, stocks for that example. You've invested in shares of some companies which are lying in your demat account. Now, you know for sure that you're not going to be liquidating them. They're long-term investments for you. And in case you come across a requirement for money. So there are two alternatives. One is that you liquidate, you sell your mutual funds or your shares, use that money for what you require it. And once that purpose is fulfilled, then you buy those shares again. Now, this essentially is not a very prudent way of going about it, especially if you need the money only for a temporary purpose. Okay. So the alternative is that I have some investments. I know I require some funds only for a few months, for example. So I take a loan against those securities. So when I take a loan against those securities, I am not essentially selling them. I'm only borrowing against putting those securities on mortgage.
Basically, it's collateral.
As a collateral. You use it as a collateral. You give it, you pledge it or you mortgage it in favor of the lender. And you get a certain amount of money against it in the form of a loan, which you use for the purpose that you want to use it for. When you have the liquidity again back, you pay it off and you free your shares or securities. So that's the concept of loan against securities. If this product did not exist, for example, and I had certain investments in stocks or mutual funds, I have a temporary requirement for money.
You would have to sell.
I would have to sell them. So this is a very, very nice tool, a very good liquidity management product, I would say. And if used effectively, it works very well for people who have short-term requirements.
So let's first, before we get to the use cases, talk about the options first, right? The service itself. So one would assume that since it is a loan against a security, there is collateral, there is what is called a loan to value, right? Like a house, where you say that you have a 20% down payment, effectively you get 80% of the value of the house.
That's correct.
So in this case, what is the loan to value normally given to you in a loan against security?
Well, so there are different securities that we're talking about. So one is if you're invested into equities, either through mutual funds or direct shares. So the loan to value would be about 50%. So that's linked to 50%.
50%, okay.
So if your portfolio is 1 crore worth, you will not be getting a loan for more than 50 lakhs because the equities are volatile assets. So there is a margin of 50% on that. Now, if you have a debt mutual fund, for example, the loan to value, the loan to value would be approximately between 75% to 80 or 90%. So because of course they're less volatile as compared to equities. Now, interestingly, the limit for listed debt securities has been removed. I mean, you can take a loan, of course, the loan to value will be limited, will be at the quality of the paper, etc. And that's at the discretion of the lender. But in all possibilities, you would, if the quality of the paper is good, you could go up to even up to 90%.
Okay, so because if it's AAA, because ultimately you're effectively talking about a high rated paper, and that the expectation or the possibility of a default by that issuer is not there. And so therefore you have comfort as a lender saying that if there is a default by the borrower, I can liquidate
them.
this.
So they'll be highly liquidable as well.
Sure.
They would be, the risk of default is very less. So that is why the loan to value would essentially depend upon the quality of the paper.
Okay, so we've established for equity, and this is what most people utilize, right? Equity mutual funds. Most people who consider doing this end up doing this.
No, not really. So
no?
it's a mix actually.
Okay.
If a person is investing into debt, for example, they would rather take a loan against debt because the loan to value is higher. And if there is any fluctuation in the prices, like suppose you've taken a loan against your equity portfolio and the markets have crashed, you need to replenish that margin.
See,
right?
Conceptually, I completely agree with you, but people end up taking loans against mutual fund units which are invested in equity, right?
Yeah, so because their allocation is more in equities, so they will most certainly, definitely, have to take against equities.
So let's talk about this, right? Because ultimately, what are the use cases? I mentioned at the start that people are talking about using it to invest more. This is now coming to the realm of tactical investments. Is that a good idea, or is that a not so good idea, or is it neither? Can it be a good idea?
So, well, I would, in personal capacity, say that you should never borrow to invest.
Okay.
So, if you're borrowing to invest is one, and you're taking loan against your existing investments to invest further, that's not the prudent way of going about investing.
Why?
So, see, what is investments? Let's look at what are you investing for to create a corpus in future. You know that if you're investing in equities, it's going to be fluctuating. Now, what you're doing is you already created a certain amount of assets. 50% of that you're borrowing to invest further into an asset which could be speculative in nature again, right? So, what is the ultimate purpose that you're achieving? You're going to be paying an interest which is in the range of 10 to 11%.
Is that always 10 to 11%, or is it?
More or less 10 to 11%. It could even go higher for that matter.
It could go higher.
Yeah. So in all probability right now it's about at about 10.5%.
But can I ask why that is, just conceptually? Because if you think about it, if we're talking about a debt mutual fund in this case, right, as collateral, it is, as we pointed out, not as volatile as equity. And so you can kind of compare it to a house, where a mortgage you will get at today's rate at what, 7 point something percent, right? Effectively. So why not get a loan against security at that rate?
So this is not a home loan, right? That's a very specific category of home loan that we're talking about.
The duration is much longer on a mortgage.
Yeah. So we're talking about a home loan, which is, I'd say, about 7 to 7.5% right now.
Sure.
Not 7 really, but 7.3 to 7.5 or whatever.
Yeah.
Against this, in comparison to that, what you're doing here is that you have certain debt mutual funds or equity for that matter. You're getting liquidity within probably half an hour now. In today's times where everything is online, you simply create a pledge online and the limit or the money is given to you within, say, probably a couple of hours.
What is the term that normally you get for a loan?
So it could go up to 3 years essentially when you begin with.
Short term,
So when you begin with, some of the lenders would give it only for 12 months to begin with. Some could go up to 3 years. So the idea is that still, if you ask me, 10.5% for something that you have invested in already and just getting it collateral, you're putting that as collateral and getting some limit against it, I believe 10.5% is pretty reasonable in that point. See, look at the cost of capital for the lender as well. Yeah? So there has to be some margins that they have to keep as well. So you're getting money at 10.5%. You're borrowing against your existing investments. There is a margin call that you could always have over there because of market fluctuations.
Explain margin call.
Okay, and then I'm trying to talk and finish that circle where we're talking about why doesn't it make sense to invest with borrowed money?
Yeah, because you would have to necessarily, if it's a 1-year loan, for example, your investment will have to give you more than 10.5 to 11 to 12%. In that case, you're probably venturing into a slightly riskier asset. So there's always a possibility of that investment not doing well. And so if it loses money and you have to give interest, it's a double whammy.
Absolutely, and it beats the concept of investments, right? You're not investing, then you're speculating, then you're trading, then you put it all other terms that you may want to. So these are over-ambitious approaches to try and maximize creating wealth by...
But alternative, let me make an argument, right? Just so that we are arguing both sides. You have a situation where your equity markets in India have underperformed for a year and a half, relatively speaking. All equity markets around the world have done incredibly well. The fundamentals of the Indian equity market are relatively strong, earnings are picking up, and the economy is doing okay. The expectation is that with a US trade deal out of the way, Europe trade deal also signed, the expectation is that things will look up. You don't have money that you would normally have deployed in the equity markets. What is the harm in saying that I am likely to get 14% in all probability, and reasonable assumption, 12 to 14% on equity in 1 year's time?
So on one end, you have an assumption of 12 to 15%. Okay. And the other hand, you have a fixed expense of 10.5%.
Right.
Okay. Do you really want to trade that off with the overhanging sword on yourself saying that global markets are so volatile? It's not only about the US tariffs being out of the way. It's not about the, India, UE, EU trade deals. There could be so many other events that could take place, right? And what happens in that scenario? And what is the trade-off eventually? So if you're going to pay 10.5 plus your processing charges, plus your annual maintenance, etc., pledge charges, whatever if there are, and you're going to make about a 14%.
So you're only getting a difference of about 3.5 percentage points.
One logically does not make sense. And the other is it's not theoretically the right way to create wealth.
Okay.
I mean, that's not the way you should be.
I'm glad that I'm arguing the other side so that we've gotten the answer, right? So what is this margin call that you referred to?
So now further to that, you're exposing yourself to another event, which is if the markets crash. So you've taken loan against, say, a 1 crore portfolio, you've taken a 50 lakhs loan, right? That is the one overhang that you have on yourself. If markets crash and the value of that 1 crore has come to 80 lakhs, for example, okay, I would not call that a crash, 80 or 20%. Yeah. So if it comes down 20%, you have to replenish because now your loan eligibility is 40 lakhs.
Sure. And you've taken a 50 lakh loan.
And you have an exposure of 50 lakhs. You have to replenish that 20 lakhs worth of securities to maintain the 50 lakhs of loan. Now, if you're not able to do that, what are the consequences? The lender will sell the shares.
Sure.
To recover their money, right? So you have one overhang of markets crashing. The other is then you've borrowed money to invest, and wherever you invested has also come down.
Yeah. So is this how the margin trading facility also works?
Margin trading is a little different. Margin trading is different, but it is on the same concept. Now, unfortunately, that is for people who want to take overexposure into the market. So they have some securities deposited with your broker in this case. And the broker extends to you certain limits against those. So again, it's the same thing. I'm saying it fundamentally goes against the principles of prudent investing, right? You don't call yourself an investor then.
So
then you call yourself a trader.
Okay. So if you're not using it for this purpose, what would you normally use it for?
So we have use cases where we've also facilitated and advised our clients to go for loan against shares for that matter. Say for example, there is an annual bonus that comes to salaried individuals. Now, if it's coming in the month of April, and you know it's going to come to you, and you're sitting in the month of February, for example, and you need to buy something, you make payments for something, which you don't want to wait till April. And you know April for certain that money is going to come to you, which has already been identified.
So it's cash flow, but it's in the future.
Correct. Say 2 months away from now.
Sure.
And you have certain investments in your mutual funds, for example. You borrow against that because you know it's only for 2 months, right? And there's a short event of money coming in. And right now there was a payment to obligation to make. So you borrow against your mutual funds, you pay off that obligation, you have a 2-month loan that is active. When you get your bonuses, you pay off and you pay off.
So give me an example of these obligations. Something that you can explain this with.
So there was an investment opportunity, could be, which is only for 2 months. I'm just saying it is only about capturing the price. We're not leaving it open.
So it could be an IPO, for example.
It could be an IPO, for example. And that's an investment that you anyways wanted to make, just that you did not have the funds at that point in time. The other would be probably a holiday, where you would otherwise take it in April after the money comes in. You say that, look, I can go in March if I want to, just that 1 month, and I will plug it in back.
And I don't want to sell my equity.
It doesn't make sense to sell your investments for this, especially for this. Right? So if there is any payment obligation, which is a very temporary requirement for money, you only fulfill that requirement against a future cash flow that you are certain to get.
Is there a duration that is appropriate in your mind? And this is the last question pretty much. That is appropriate to use this for? One would assume that at 10.5% or 11%, you're not going to look at a 3-year loan because your interest outgo is going to be high.
No, so see, basically, you can use loan against securities for a temporary bridging of cash flow. That's
so
all.
It's months and not years, basically.
Essentially, it should not go beyond 1 year. And the good part is, here is many lenders have migrated to a system where they will give it to you as a limit. So when you've pledged your securities, you have an open limit. So in this example, if you have pledged 1 crore worth of securities, you will have a limit, an overdraft limit of 50 lakhs. The moment you withdraw and the quantum you withdraw, you pay interest of only that much. For example, you've taken only 10 lakhs out. You pay interest only on 10 lakhs, but you have a limit of 50 lakhs available in case you want to use. So you can keep the loan active, overdraft active for 1 year or 3 years for that matter, and withdraw as much as you need on case-to-case basis. Do not. My only concern, and why I'm highlighting this, and I'm actually very, very concerned for investors who are very enterprising, and who borrow to invest further. I think it's a double whammy, and if things were to go down, everything will spiral into a...
This is the reason why I argued so vociferously on the other side, not because I believe in the concept. I want to make that clear.
Right.
Harsh, I think it's been a pleasure, as always, speaking to you. Thanks so much for joining me today.
Always my pleasure, Alex. Thank you so much.